I believe that many of you guys are sick and tired of hearing of the same stocks over and over. I mean, if you think about it, every single video on YouTube is pretty much about the same stocks, about the big seven, how amazing Amazon is, how cheap Google is, how amazing Nvidia is, how amazing Microsoft is, Meta, Apple, Tesla. And those companies are amazing. And I do talk about Google a lot, how cheap it is, how amazing Amazon is, which I own in my personal portfolio. But I believe it's time to talk about something different, bring in new ideas, cover something else on the channel. And that's what I'm going to talk about today. And I'm mainly going to talk about defensive stocks or recession resistant kind of stocks. And for my personal portfolio, I try to not go all in tech. If you go all in tech, it's like you have a leveraged NASDAQ ETF. Whatever the NASDAQ does, you're going to do a little bit better or you're going to do the same. But if you have something that's kind of uncorrelated or something that's a little bit different, your portfolio will fare much better in drawdowns or whenever the economy is weaker or whenever ad spending isn't as strong, which is something that a lot of the big seven benefit from. If we have weaker ad spending, it's not going to be good for a lot of their earnings. So I'm going to talk about some defensive stocks, kind of like the consumer staples. I mean, those are boring companies. At one point, they were up 5%, while the NASDAQ was down 7%, and they're still outperforming the NASDAQ year to date. So the first one is a very popular defensive stock with a lot of pricing power. A lot of people hate it, a lot of people love it. So I'm going to talk about it again. The second one is more of an under the radar stock that not a lot of people know. It's one of the best performing stocks of all time. It's up like 15,000%, but it's not well covered on YouTube. So I'm going to talk about it again, and I really hope you enjoy it. As always, the first stock that I'm going to talk about, and it's been a long time since I talked about this one, and this is Pepsi. Pepsi is down 13% over the last year. It's been a disaster for the stock. It's a stock that I told you guys about my strategies that I used to get in and out of the stock because it used to be very predictable. So I used to get in under $165 and I sell around $180 or above. I used to make 10 to 12%, every 2 to 3 months with the stock. It was just extremely, extremely predictable. But lately, this hasn't been the case. Pepsi has broken down from this over 3-year trend, and it's now sitting at $148 at a very attractive valuation, almost near the COVID lows of 17 times earnings. And I highlighted that on X. This is extremely, extremely cheap for a company like Pepsi. And I'm going to talk about the dividend of Pepsi, the high debt of Pepsi, and all the concerns that a lot of you guys may have. Now, if we look at Pepsi, it's not just about sodas. Yes, sodas are declining in volume, but Pepsi has much more than sodas. They have, the Gatorade brands. They have so many different kind of brands, and the chips and the Frito-Lays and Doritos and all these, just a lot of water brands. They have so many different brands that, a lot of the growth over there, it's offsetting the decline in the soda business. But over 58% is in convenient food and 42% is in beverages. 60% is in North America and 40% is international. And international has been massive, massive growth for them. A lot of their brands are still growing double digits, like Lay's is still growing double digits, Cheetos, Doritos, they're growing double digits. They're also growing double digits in many international markets like Mexico, Brazil. India is a massive market for them. They're growing very rapidly in India. So a lot of the growth over there is offsetting the decline. They're also diversifying a little bit more into energy drinks and so many different kind of brands. In Celsius, they have a stake in Celsius. And they've been diversifying over time and healthier kind of stuff. Now, if we take a little bit of a deeper look into the financials, earnings per share grew 17% in the first quarter. If you look at the chart, you wouldn't guess that Pepsi is still growing 17% in earnings. You would guess stock is declining in earnings. It's still growing 17% in earnings. Full year earnings growth was 6%, and this is including a 2% impact on a foreign exchange. If it wasn't for that, it would have grown 8%. This is not a dying business, guys. This is pretty impressive. Again, for a company like Pepsi, for a mature company like Pepsi, it's still very impressive in my opinion. Now, if you look at volume was only up 1%. Most of it is through price increases because they have pricing power. They can raise prices every single year. And people, they keep saying Pepsi cannot keep raising prices forever, yet Pepsi keeps doing it every single quarter, and they keep growing earnings per share 7 to 8%. So I believe the company is going to keep doing that for many, many years to come. Now I'm going to talk about the dividend. The dividend right now is the highest it's been since the data that I have, which is since 2013, the highest ever. I mean, look at this chart. It looks like it's screaming buy just looking at the dividend yield. 3.8%, almost a 4% dividend on an amazing company like Pepsi. And the dividends, they've been paying it for 53 years. 53 years at 7.5% CAGR of growth. They grow the dividend rapidly, and it's a pretty good dividend, so I like that with the company. Now, the main concern I have, and this is based on the comments I used to get, is that Pepsi's payout ratio is over 100%, which means Pepsi is going to cut the dividend. The payout ratio is not 100%, especially if you look at it on a free cash flow basis. Now, if we look at a free cash flow basis for 2024, they made $7.1 billion in free cash flow. They paid $7.2 billion in dividends. So yes, it looks like the payout ratio is over 100%, but they had $1.7 billion in net changing in working capital. This is just a one-off. This is not something that's going to happen every single year. If you look at their previous years, it used to be 300 million, 800 million, 700 million gain. So it's between 3 to 400 million variation, but it was never $1.7 billion. So this loss of 1.7 billion is going to be a gain on next year's free cash flow. So if you add the 1.7 billion and we adjust for net working capital, in reality, they didn't only have enough to pay the dividend, but they had around $1.5 billion left in free cash flow for them to pay down the debt or do buybacks. So the payout ratio is nowhere close to 100%, especially looking at the potential profitability of the company. Once we adjust for net working capital, free cash flow is pretty close to $9.7 billion. So dividend is $7.2 billion. So they have more than enough, over $2 billion left in free cash flow for them to do buybacks, to pay down the debt, to increase the dividend. So the payout ratio is much less than 100%, and it's very safe. I don't believe Pepsi is going to cut the dividend anytime soon. And that's just something I wanted to explain to you guys in the comments that told me, the payout ratio is over 100%, which means the company is trash. Again, it's not 100%. Now, the second, risk or the second worry that a lot of people have with Pepsi is the debt, because they have so much debt. I mean, if you look at the net debt, it's $38 billion. So this is total debt, and then you take out the cash position. The total is $38.5 billion. This is a lot of debt. But I just want to remind you that Pepsi has a very predictable business model. It's kind of like a telecom business model. Like a lot of people look at Verizon, they see Verizon has $100 billion in debt, and they say this is a trash company, it's not worth owning. I agree that they have a lot of debt, but Verizon would be dumb not to leverage up the balance sheet and increase return on equity with such a predictable business model. They need to use a lot of debt. Like some companies are meant to use a lot of debt if they are predictable in revenues. Pepsi is a very resilient, very predictable company. So if Pepsi had zero debt, I would not invest in it. Because the management would be dumb not to leverage the balance sheet to do M&A, to do acquisitions, to benefit shareholders over the long term. They would be dumb not to have some debt on the balance sheet. And especially most of it is low cost, kind of debt at 3% interest rates. So to me, that is not a worry with Pepsi because of the predictability of the business model, because of the pricing power of the business. And again, the debt for me is not a problem. And a lot of companies are meant to have a lot of debt. And they would be dumb not to use debt. If Pepsi had no debt, I wouldn't buy it. I would know the management is dumb. They're not taking advantage of the balance sheets the way they should be doing, and I wouldn't even touch it. Now, some companies, like cyclical ones, they should have zero debt, but a predictable business like Pepsi should have a lot of debt. So to me, it's not really as big of a worry. Now, if I look at the PE ratio, I told you guys it's at 17 times earnings, almost 17 and a half. The lowest it has traded at was 15.8. The highest was 27, and the mean was 21 times earnings. So we're much closer to the low end of the range than the higher end. The high end is 27 times. The low end is 15 times. And if we look at the management's own guidance, they still have high single digits in earnings per share growth. This is not much of a revenue growth story, although they expect 4 to 6%. But for earnings per share, because they can raise prices and do some buybacks, 0.5% to 1% per year, alongside margin expansions through raising prices, they're going to grow 7 to 8%, like they did for the last 10 or 20 years in earnings per share for many, many years to come. Okay, now here's my valuation model. I took the current earnings per share of $8.16 and I put in $8.16 for the next 5 years, growing at a rate of 8%. So this is based on the guidance of high single digits for the next 5 years. Okay, I would get $11.99 in earnings per share. Okay, now we look back at the valuation. The valuation right now is around 18 times. The mean was 21 times. And Pepsi, many times, it has gone to 17, 18 times. People give you all kind of arguments. It's whatever. Now it's Ozempic. Now it's inflation or Kennedy or whatever it is. And the company manage it and they come back and then they go back to the mean. And that's how it has been. So I wouldn't really bet against that. So I believe 5 years from now, Pepsi is going to be a better company. It will likely go back to the mean of 21 times. So I'm going to take this number of $11.99 per share of earnings per share, and we'll time it by the mean multiple of 21 times. This is $251 per share. 5 years from now, we divide by the current price of $148. We get around 70% on the upside. So I'm seeing 70% on the upside over the next 5 years with an amazing, safe company like Pepsi. And plus, on top of that, you're also getting a dividend. The dividend is around 3.8%, pretty close to 4%. So in total, I mean, you're getting pretty close to 100% on the upside. And you don't get that very often with a safe company like Pepsi. So for me personally, I'm liking Pepsi very much over here. I might buy the stock again. I've been on the sidelines, mainly buying the dip on a lot of the riskier stocks, growth stocks, as they've been going down. But I'm starting to like Pepsi over here. In my opinion, it's getting too cheap to ignore. And I might own the stock again. I'm liking it very much. I believe it's presenting an amazing buying opportunity if you're looking for a safe dividend stock to own in your portfolio. Okay, now this is the second one that I'm going to talk about. And I talked about it before, but it's been like 6 or 8 months since I mentioned the stock. And this is a stock called ATD, which is alimentation. I talked about it on X. A lot of people loved it. They loved that it has 15% return on invested capital. The PE is 16. Shares outstanding went down 4% last year. It's a recession-resistant business model. Amazing management team. A lot of people, they really love the company, and they asked me for my opinion on it. Okay. Now, ATD is very popular in Canada, but it's really popular everywhere. It's one of the best stocks of all time, up 14,632%. And they mainly own a lot of the gas stations and convenience stores, over 16,861 convenience stores all over the world. Maybe you've seen a Circle K convenience store. The Circle K convenience store chain is owned by Alimentation. They own a lot of them. They own car washes. They own so many different businesses. And again, it's a very boring business, but it's pretty safe if you think about it. And a lot of people, they go to the gas stations, they pick up something, they fill up their car, and 48% of the revenue, or gross profit, I should say, is from fuel. 51% is from merchandise and services. And the company does a lot of acquisition, a lot of M&A. They acquired the Total Energies convenience stores in Europe. They acquire car washes and they link them to the gas stations, so they have a flywheel effect, and they acquire so many different things, and they're very good at M&A. They returned very high return on invested capital, and it's an amazing management team in general. In terms of EVs or electric vehicles, the company is also on top of that, and they have built many sites in Europe with a lot of those charging stations. And they actually found out that if people sit in their car and it takes them, let's say, 20 to 30 minutes or an hour to charge their car, then while they're waiting for their car to be charged, they will likely eat some chips, they will likely eat, drink something, they will likely consume something from the convenience store. So they actually found out that it was much more profitable than expected for the EV stations than just having gas where they come and leave. If someone is sitting in their cars, they're going to get hungry, so they're going to eat something. And this is where the margins are made. They're made inside the stores. They're not made from selling electricity or selling fuel to the public. So this is it surprised me a little bit. And it's not as much of a headwind as a lot of people believe it is on the ATD. And for M&A, they decided to step it up in a major way, and they want to acquire 7-Eleven. A lot of you guys know 7-Eleven. It's owned by Seven & I, and they went to Japan, and they made a presentation of the stock of ATD, the stock of Seven and I, and the difference, and they're trying to acquire them. And if they are able to acquire Seven and I or 7-Eleven, this is going to be a monopoly. It's going to be insane. I mean, I can only imagine. This is the biggest competitors. I can only imagine the synergies and all the savings and all the things they could find. I mean, is they going to be undefeatable? And the main reason why the stock is going down is because they're deciding to use a mix of debt and equity for them to acquire them. So there's going to be some dilution along the way. And this has been a company that's well known for buying back a lot of stocks. They buy back so much stock. They don't have little to no dilution, almost never. So they're very good with their own shares. And now they want to dilute the stock to acquire 7-Eleven. And this is why the market is kind of worried. There's a lot of uncertainty. But for me personally, I don't believe this is going to go through. I don't believe it's going to go through in Japan. I don't believe it's going to go through in the United States. I don't believe it's going to get approved. It's going to be a monopolistic kind of company. I mean, I highly, highly doubt if Seven and I even agrees to a deal, the US is going to allow it to happen. I would be shocked. So this is where I see an opportunity to kind of benefit from the uncertainty that's happening around it. And another reason why the stock is going down, and it's not the only one, a lot of those convenience store stocks are going down, is because oil is going down and they will likely have lower fuel margins on their sales. So a lot of their margins might suffer this year after having record margins in 2022, whenever a lot of the refiners, they were making crazy spreads, crack spreads on fuel. This is no longer going to be the case, and this year is going to be really bad for them, and they're going to suffer on margins a little bit. So this is another reason why the stock is going down. We look at the PE ratio. It's now trading at 16 times earnings. It traded as high as 20 times, as low as 14 times, and the mean was 17.5, now trading at 16 times, which has historically, you could say, been a pretty decent time to be buying a company like ATD. And ATD's earnings per share over the last few years hasn't been too predictable. They had 20% in 2023. They had tough comps. Was 2024, it was negative 10%. This year is only going to be 1% due to the fuel margins and many different things. Then it's going to pick up to 11, and then it's going to pick up to 16. Although the long-term average has been, 15%, 17%, sometimes 27, sometimes 23. But it's mainly been around 15 to 17% in net income growth, or mainly earnings per share growth. But the best way I would think of ATD is you mainly have to trust the management and trust them as capital allocators, because they do a lot of M&A, and they have a target of a return on invested capital or return on capital employed of 15%. It has lately been 13.3%, but their target is 15%, and they have achieved 15% for many different years. And if you look at the CAGR of the stock over the last 20 or 30 years, it has been pretty close to 15 to 17% per year. And this is something that Charlie Munger said. He said, over the long term, it's hard for a stock to earn a much better return than the business which underlies it earns. If the business earns 6% on capital over 40 years, and you hold it for that 40 years, you're not going to make much difference than a 6% return. Conversely, if a business earns 18% on capital over 20 or 30 years, even if you pay an expensive looking price, you'll end up with one hell of a result. So in this case, you're not only buying a business that's returning 15% return on capital employed, but you're also buying it at a discount to the mean for a recession-resistant kind of stock. So for me personally, ATD is looking extremely interesting over here. Again, this is another stock that I used to own. I might go back in the stock and look at how earnings come up. I believe they're coming up on Tuesday, so I'm going to be watching earnings, and it's looking very, very interesting if you don't want to go all in tech stocks. And I share everything I do in my own group. This is the link if you're interested. And I hope you enjoyed this video. It was something a little bit different. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.